the SEC, if you're watching, you need to make this illegal.
We have 3 or 4 meetings with the SEC.
You should just play them this episode. You can cut that.
Everyone, this is the King's Crowd Investment Roundtable. We're back for another great discussion this week where we are going to be covering some very good topics, such as the Q3 2024 investment crowdfunding data is out. We're going to take a look at some of the top raises over the past quarter, and Teddy will be filling us in on that. Then we're going to be handing things over to Leia, our other guest here today, and she's going to be talking about some different marketing, financial, and other ways of spinning different data on campaign pages by issuers that investors should be looking out for. Sometimes these things could be red flags. Sometimes it may be masking underlying issues. And we're going to be discussing how to detect some of those, what some of those tricks are that they might do, and what investors should be aware of. Lastly, we'll be quickly touching on the tax extension deadline that is coming up in next week, October 15th. So for everyone who had to file extensions because you had K1s, we will be briefly touching on that. Let's first kick things off. Teddy, I will hand it over to you. Tell us about the Q3 2024 numbers.
Yes, thank you, Brian. So this is a chart that we've recently brought to the King's Crowd newsletter, where we wanted to provide a chart that's a bit more interesting for investors in terms of what are the top companies raising, and in terms of the King's Crowd ratings, and of course, what companies have raised the most. And this is a quarterly chart. It's our first quarterly chart in a long time. So we're going to start doing these quarter by quarter so we can kind of compare, especially for the second chart. You'll see where we go over which platforms have done the most, which industries have done the best. So here we have on the left-hand side, we have the top rated companies by the King's Crowd ratings algorithm. So see a lot of familiar names here. AtomBeam, it's an IoT startup. They've been around crowdfunding quite a few times. And they were they were one of the top rated companies for our August chart as well. Liquid Piston, creating the next generation of combustion engines, Alleviate. They play in the physical therapy space, so creating a lot of the actual hardware, if you want to call it, for physical therapy. I believe they actually pulled their raise, unfortunately, recently, but I'm sure they'll be back around at some point. Then Intergen Data. This is actually a company I was introduced to like 5 years ago at my first job, and they basically predict life events using AI. And it was very interesting for insurance companies to use when underwriting certain insurance policies. So that's cool to see them back here raising an equity crowdfunding round. So that's very cool. So that is the top companies and top raised companies. The second chart we have is just kind of a snapshot of the equity crowdfunding industry as a whole. We see that media and entertainment companies raised the most across equity and debt. Dealmaker, who specializes in Reg A's, they raised the most, which is not that surprising because Reg A's tend to raise a lot. So total new deals 356, closed equity deals 115. Kind of go through all these numbers, and if you're looking for kind of a snapshot of the industry every quarter, make sure to subscribe to our newsletter. So kind of keep up with the happenings of equity crowdfunding.
Awesome. Yeah, I think when we were taking a look at just the investment rate, kind of averaging close to $1 million a day for Reg CF. So this number obviously also has about half of that from Reg A, but Reg CF this year probably going to end the year between $350 and $400 million raised. That's what it's looking like. Awesome. Anything else, Teddy, on that?
No, I think that's good. It's another strong quarter, and hopefully in the next few quarters, the next year, we'll see the equity crowdfunding market continue to get back to its 2021 levels, hopefully.
Yeah, if we pull up the markets chart, that's a really good point, and take a look at this. So this is the number of raises over time, and you can see every May that, we do get a little bit of a dip here. That's because when the financials are due, a lot of companies will tend to close before that 120 days after their fiscal year, so they don't have to post the updated financials. But you can see we're hitting, kind of 12, 18-month highs here in terms of the number of active raises This is Reg CF only, and this is equity deals, but exceeding pretty much all the deal volume over the past year, going back to kind of mid 2022. So it's definitely starting to see a tick turnaround, and also in terms of the amount raised, it's coming back up. So great. Well, thank you, Teddy. Let's head to our next segment. So we want to talk about a couple things that we see that can be potential issues, or at least areas that investors should focus on and ask questions about and dig deeper into when looking at a campaign. So there's a couple charts that we want to show when an issuer may be trying to hide something or obscure something that might not be painting as rosy as a picture as they would like. One example is when we see revenue charts like this. So if you can see this revenue chart here, it shows 2019 actuals as, less than 0.1 million, so 100,000. And they actually group 2020 to 2023 actuals in one bar, showing 60 million, and claim 32,000% growth. Now, there's nothing factually inaccurate with this chart, but if you actually look at the data and pull out the 2020 through 2023 numbers, you'll see that the revenues have actually been declining year over year for some of the most recent years. So oftentimes, and we have seen charts like this more than once, if issuers are lumping things together to try and show it like this, make sure you're digging into that underlying data. This is one of the things that is, again, it's not factually incorrect, but it can be misleading a little bit if you're not actually getting an understanding of that. Now, I'm going to be handing things over to Leah now to talk about some other places where we see this and some other potential flags or question areas that investors should be keeping an eye out for.
Yes, Brian. Continuing on this revenue topic, let's take a look at a company that is currently raising right now called GrandFloor. Similarly, GrandFloor is misrepresenting the revenue. So here, and they clearly stated, they chose to represent pro forma revenue, which is not GAAP revenue. GAAP is a system that is used in the United States to make sure that every company reports their financial equally. And so as an investor, when I review companies' financial, I want to review GAAP financial against GAAP financial because I know that everybody uses the same technique. I know that the audits are pretty similar, and that way I know where a company stands compared to another one. In this chart, it looks like from a pro forma accounting perspective, the company has been growing in revenue between 2022 and 2023. What actually happens if you look at the actual SEC filing, which we reflect on kingscrowd.com, we can see that the revenue has been declining between 2022 and 2023. So the company is not doing as good as it's looking at. Of course, this is not false. There may be an interest for investors to look at pro forma revenue, but if you want to compare apples to apples, you definitely want to see that the company has been losing 1 million in revenue. The other problems that I have with that is that even if GrandFloor shows us pro forma revenue, I would like them to show me the details of the differences between the two techniques. So as an investor, I can know that, all right, maybe for this company, pro forma is more accurate because they may have some revenue line that should be recognized that will show the performance better. They may have expenses that may not have to be included, may be a one-time expense that I should be about. But I would like founders to give me an explanation. It wouldn't look shady, but it will look transparent. And this would be what I will appreciate as an investor.
Founders' jobs are to raise the most money that they possibly can. So in a way, I kind of understand why we see some of these charts that kind of show the revenue in a, as Brian said, like a more rosier type of way. I understand why they do that. But like Leah said, I would like to at least see an explanation for why they are putting it forth in this way. Otherwise, I do kind of see it as like a serious misleading of investors, as like what's in the SEC filings is the true performance. And like Leah said, if there are some reasons like one-time expenses, like if you explain all of that, give us all the information, sure, like you can post these all you want. But I just would like to see more transparency on this type of thing, and as the industry as a whole, like there are a lot of issues.
So everyone's aware the regulation. So regulation crowdfunding requires that your financials are in GAAP accounting format. So even if it's not an audit, even if it's only CPA reviewed, even if it's self-certified. So those are some of the different financial levels, depending on how much you're raising, of what kind of review or potential audit you might have to get. It still has to be in GAAP format. So it should raise questions in investors' minds, right? If you're seeing non-GAAP revenue pro forma being presented. Now, granted, maybe it just wasn't prepared yet or not ready. There could be other reasons, but those are questions you need to ask the founder to have an understanding.
I mean, it's not just an equity crowdfunding. When I was in investment banking, there were non-GAAP, GAAP charts we had to make. There's EBITDA, adjusted EBITDA to make companies look better when you're presenting it to private equity buyers. So it's not just for startups. Like, this happens in high finance too. But just as retail investors, it's something you definitely want to dig deeper on.
Showing pro forma revenue is not illegal. It is the founder's right. We're just highlighting this so as an investor, you know that it's important to also check SEC filings. As an investor, you don't have to be an accountant. You may not be able to know what's the difference between GAAP and non-GAAP. And that's why the SEC wants to make it easy for you to compare companies with GAAP financial versus other companies with GAAP financial for you to make your choice. So don't hesitate to go on the SEC filing directly, or even better, look at the company's financials on kingscrowd.com to make sure that you have a clear representation of a company's financial.
And we're going to be revamping the financials soon, so stay tuned for that.
That's right. Keep an eye out for that.
This is not the only thing that annoys us as investors. And I want to say annoy because Teddy and I have been probably looking at close to 2,000 deals in the 3+ years that we've been in the industry. And one thing that particularly annoys us is when companies do not publicly disclose the valuation on the risk page. Here is an example of a company called Cars and Coffee. If you can look at this FAQ, the race page asks what is the current valuation of the company, and the company answers dollar, which is established by the company. I feel like they're making fun of us. Why do you even have to write that down on your race page? It just doesn't make any sense. And that, I don't know, is it that they just forgot about it, which tells a lot about how the founders care about quality? Or is it that they are trying to hide this valuation? Another broker dealer that does that a lot is Dealmaker Securities. There's a lot of great things about Dealmaker Securities. We definitely like them. But one thing that particularly is annoying for investors is that they do not clearly state the valuation of the companies. So what happens? Most of the time, investors have to ask in the Q&A section, what is the valuation of the company? Here, in the case of Templast, which is a very popular raise on ACF platform, the valuation was not clearly stated. So an investor asks, what is the valuation in this round? And somebody in the team answers that the valuation is $98.9 million. Our job at KingsCrowd is to go into the Form C for you and try to calculate the valuation for you. When we did this calculation, we only found about 45 million outstanding shares, which multiplied by the price per share gave us a valuation of $85.7 million. There are a couple of reasons for that. Maybe the company did not report the options or warrants, which means that we could not calculate a fully diluted, or we could not have the fully diluted outstanding shares. It could also be that the company issued shares between the moment where they reported their shares and the start of the company. But without explanation, we don't really understand where this valuation comes from. And if the founders will not, or the team members were not to show us the valuation of the company in the discussion section, we will be completely in the dark compared to that in that deal. So what we do at KingsCrowd, when the founders do not disclose the valuation, we try to do our best to calculate it based on the information that are available on the Form C. And on the deal consideration on the right, you're going to see a red dot that is going to tell you that the valuation of the company is unsure. So in the case of Templast, it doesn't show up anymore because the founders ended up giving us the valuation. So we updated it at $98.9 million. But this is something that you will have to look at when you look at a deal. Is the valuation that you have the real one? or did we have to calculate it on our own, which of course leaves room for error given that founders do not give us all of the details.
I think another thing to understand too, right, why that calculation is so hard sometimes is that it's not just straightforward where you can take clearly the number of outstanding shares and multiply it by the share price. There could be additional dilution or other things on the cap table, such as convertible securities, safes, different notes. So usually the number you want is not just the number of currently outstanding shares, but you want to know what would be the fully diluted potential valuation if all of those safes and convertible notes and past things also converted. That's why it can be really tricky where if these companies aren't disclosing that or calculating it for you and they're making investors calculate it, it's just, again, a question of, why didn't they just provide that? Why isn't that something that's available on the raise page? Because share price in and of itself, if you just compared $1.89 here, right, that means almost absolutely nothing without the number of shares associated with that. So you can't just look at something and say, oh, that's a cheap share price, or ooh, that's an expensive share price. It really matters what valuation you're investing at. But Teddy, I know you have some feelings about this as well. What do you think in terms of the whole valuation discussion?
So, number one, the SEC, if you're watching, you need to make this illegal because it's like not okay that, especially like retail investors, which may not have like deep finance backgrounds to like, go through the SEC filings and look for outstanding warrants and incentive plans and like know which ones go into valuation. So it's like there's a company called Naples Soap Company that doesn't disclose their valuation, and if you calculate it based on just outstanding shares, so it's probably higher than this. It is like 7 billion, and that
Billion with a B.
with a
You
B.
said? Okay.
And when I saw that, it's like I was wanted to throw stuff. It was like frankly upsetting because it's just like this industry needs more transparency and allowing companies to not publicly just put the valuation at the top the way all the Reg CF companies have to. There are even some Reg CFs that don't, but for like the major platforms like Start Engine, WeFund, like it's always right there. It's literally the most important thing. One of the most important things, if not the most important thing when investing in a company, is what is the valuation and how does that affect the upside? And like, is there upside still to be captured by investing in this company? And by not placing it, it's just, they're just going off of, they're not seeing the most important thing. And it just makes my blood boil. So the SEC, for the love of God, make this illegal.
Here you go. So yeah, 7.5 billion valuation. Now, granted, you got to take everything into account when looking at valuation, right? So I'm curious, okay, financials, yeah.
The company is a good company. It's just, what
Yep.
is this all about?
That, right, just harkening back to our discussion a couple of weeks ago, talking about some other companies like Boxable, but you can still have fantastic companies. But as an investor, if you're aiming to make a good investment return, it doesn't matter if the company is fantastic. It matters what the deal terms are that you're investing at. So just keeping that in mind.
And also, while we're at it, if you're watching the SEC, which you're not, but Form C is searchable because it is outrageous that anyone can't just go into there and control F it. And shout out Republic for making, and Net Capital for making your Form C searchable by Control F.
As well as Dealmaker Securities.
And Dealmaker, yeah. So that's actually not even at the SEC. That's more at the platforms. Please make your PDF searchable because people that don't look at those, like me and Leia, know where to find info in those because we've seen a million of them. But retail investors that, this is not their full-time job, like they don't know exactly where to look for stuff. So it's also unacceptable that those are not. Control F. Now my rant's over and we can move on.
Brian, Teddy and I are very frustrated because we cannot search Form Cs and some platforms are not disclosing the company's valuation. Can you help us?
Actually, this is something that is going to be coming up in various discussions in 2 weeks from now. So I'm going to be in Washington, D.C. There's an investment crowdfunding summit being put on by the Crowdfunding Professional Association. And as part of that, we have 3 or 4 meetings with the SEC, with FINRA, and with different Congress members and staff on the Hill. So we are going to be bringing up some of these different positions of issues that we have, such as investors not getting the information they need, lack of transparency, lack of standardization with all of those groups. So this is absolutely something we're going to be talking about more and hopefully able to get some action in this direction to make more of that accessible and easier for investors to get.
That would be amazing. Thank you, Brian.
Well, this is just I think probably the tip of the iceberg of some of these different potential red flags, questionable areas that investors want to look at. We're going to be sharing some more of these in coming weeks, but just wanted to make sure that we're making investors aware of that. I think we're going to wrap it up here. This is another fantastic, educational, super informative discussion today. Teddy, Leia, thank you for sharing all your knowledge. And as a reminder, to get more great data-driven insights on investing in the private markets, feel free to head over to kingscrowd.com. Make sure you sign up for our free newsletter that comes out each week at Pitch Reviews. And we will see you all back next time. Thank you.